Welcome back to We Are Cosmic, the channel where we break down finance, crypto, and global money moves in a way that actually makes sense. If you are here looking for hype only, this is not that channel. But if you want real macro understanding, smart risk thinking, and honest crypto analysis, then you are exactly where you need to be. Now, before we jump in, please take a second to read the disclaimer. This video is for education and entertainment only, not financial advice. Always do your own research and make your own decisions. That said, let's talk about what just happened, because this is important. The Bank of Japan raised interest rates, and the crypto market was watching this decision very closely. For days, traders were waiting, guessing, positioning, and preparing. Even though most people already expected this move, the uncertainty itself kept markets nervous. And then the decision finally came. The Bank of Japan raised rates by 25 basis points to 0.75%, the highest level Japan has seen in about 30 years. On paper, this sounds like bad news for risk assets like crypto. Higher interest rates usually mean tighter money, less speculation, and more pressure on assets like Bitcoin and altcoins. But here is where things get interesting. As soon as the decision was officially announced, the crypto market actually started moving up, not down. Bitcoin bounced, XRP showed signs of recovery, and the overall market reacted positively. That tells us something very important. This move was already priced in. This was not a shock. This was not aggressive tightening. This was what the Bank of Japan itself called normalization, not restriction. The Japanese economy is showing moderate recovery. Wages and inflation are expected to rise together. The labor market is tight. Corporate profits are strong. And even though real rates are still deeply negative, policy remains accommodative overall. In simple terms, this was not a panic moment, and the market knew it. We have seen this pattern many times before. Sometimes markets buy the rumor and sell the news, but other times, especially when fear is already high, markets sell the rumor and buy the news. That is exactly what appears to be happening right now. Before the announcement, crypto was selling off. XRP dropped hard, Bitcoin pulled back, and many altcoins reached levels not seen since October. Then the news hit, and instead of collapsing, the market breathed a little. And that is why today's video matters. In this video, we are going to talk about what this Bank of Japan move really means for crypto. We will look at XRP price action, Bitcoin behavior, and what is happening across the altcoin market. I will also share what I am personally doing with my positions, why I am managing risk the way I am, and why leverage discipline matters more now than ever. But before we go deeper, I ask just one thing from you. Send out good energy. Give me a smile. If you find value in calm, logical crypto content, smash that like button, drop a comment, and make sure you are subscribed. It helps the channel more than you think, and it tells the algorithm that content like this deserves to be seen. This is Freaky Friday. The Bank of Japan has delivered. Fear is high, volatility is real, and this is exactly when smart investors stop reacting emotionally and start thinking clearly. Going into the Bank of Japan decision, the crypto market was already under pressure. We saw selling across the board. This was not panic selling after the announcement. This was selling into the news. Traders were reducing risk early because they remembered what happened in the past when interest rates were raised. In previous rate hikes, Bitcoin and crypto dropped 20 to 30%. That memory creates fear, and fear creates early selling. Let's start with XRP. Before the news, XRP dropped all the way down to around 177. This is important because it was the lowest price XRP had seen since October 10th. In fact, it was even lower than the November 22nd levels. That tells us that sellers were aggressive and weak hands were being shaken out. XRP did not hit its extreme wick from October, which was much lower, but it came close enough to show that the market wanted to test demand. And XRP was not alone. Many altcoins showed the same behavior. Solana dropped to around $116, even lower than its October 10th wick. Cardano, AVAX, and several other major altcoins also moved back toward the bottom of their previous wicks. This is a classic sign of a market that is revisiting fear levels to see who is still willing to hold and who is forced to sell. What makes this interesting is that Bitcoin and Ethereum did not experience the same extreme wicks. Bitcoin dropped to around $84,000. But it did not collapse the way many altcoins did. Ethereum also stayed relatively stable compared to smaller assets. This tells us that capital is still cautious, but it is not leaving crypto entirely. It is rotating toward perceived safety inside the crypto market itself. As soon as the Bank of Japan announcement became official, we saw something change. Bitcoin started moving back up toward $88,000. XRP began recovering from its lows, and the overall market showed signs of relief. This is exactly what we would expect if the event was already priced in. The key point here is this: the market did not fear the decision itself. It feared the uncertainty before the decision. Once uncertainty is removed, markets often stabilize, even if the news sounds negative on the surface. Now, I want to be very clear about something. A short-term bounce does not mean the danger is gone. It does not mean the market will go straight up. What it does mean is that liquidity was hunting stops, and once those stops were taken, there was less selling pressure left. This is also why timing the exact bottom is almost impossible. I personally missed the exact bottom because I was sleeping, and that is fine. Long-term positioning is not about catching the lowest tick. It is about risk management and probability. Right now, what we are seeing looks like a market that sold off into fear, tested support, and is now trying to decide its next direction. This is not euphoria. This is not a confirmed bull breakout. This is a relief reaction inside a volatile environment. Another important factor is leverage. Many traders were over-leveraged before the news. When price dropped quickly, liquidations accelerated the move downward. Once those leverage positions were flushed out, price was able to bounce. This is how crypto markets work, especially during periods of high uncertainty. After the Bank of Japan news came out, and after seeing how the market reacted, I decided to add to positions that I had already opened a few weeks ago. I did not chase the bounce. I did not go all in. I simply scaled in based on probability and risk. I added to my Bitcoin and XRP positions using very low leverage. When I say low leverage, I mean 3x to 5x, not 20x, not 50x. This is extremely important. Low leverage gives you room to breathe. It allows you to survive volatility instead of being destroyed by it. Right now, my Bitcoin position is slightly in the green with an average price around the $87,000 area. My XRP position is still a bit underwater with an average price around $191, and that is okay. Being slightly down does not mean the trade is wrong. It simply means the market has not moved yet. What matters more is liquidation risk. My liquidation level on XRP is extremely low, and on Bitcoin, it is far away. This means that even if we see another sharp pullback, I am not forced out of my position at the worst possible time. This is where many traders fail. They over-leverage, price moves against them 3 to 5%, and their position is gone. Then price reverses, and they are left watching from the sidelines. That is not investing. That is gambling. October 10th was a perfect example of why this matters. That day was a black swan-style event. Liquidity vanished, systems broke, and prices moved violently. Many traders who thought they were safe got wiped out in minutes. That experience is exactly why I now prioritize survivability over maximum profit. I am also only using a portion of my portfolio for these positions. Never your entire capital. Not in crypto, not in volatile markets. This gives me flexibility. If price drops further, I can manage. If price goes up, I am already positioned. Another thing I want to highlight is stop loss planning. I do not always place tight stops immediately because in highly volatile markets, tight stops get hunted. But I do have levels in mind where I will reduce risk if the market structure breaks down completely. Right now, my intention with these positions is not day trading. This is not a quick in and out scalp. This is a longer term play with the understanding that short term volatility will be uncomfortable. If I do day trade, I do it separately. Quick entries, quick exits, no emotional attachment. That is not what this video is about. This approach may sound boring, but boring is what keeps you in the game. Many people are asking, why are prices still weak if the fundamentals look better? The answer is simple. Markets move before narratives become obvious. And markets often punish impatience before rewarding conviction. Right now, fear is still high. The fear and greed index is sitting around extreme fear, near 16. That tells us most people are still scared. Historically, that is when risk to reward slowly starts improving, not when everything feels amazing. But this does not mean price will go straight up. It means expect volatility. Expect fake moves. Expect sudden 5% pumps followed by sharp pullbacks. That is exactly why low leverage and position sizing matter. After the Bank of Japan decision, many people expected chaos, but when we look at the data, nothing major actually changed. Fed rate probabilities are almost exactly the same as they were yesterday. There is no sudden shift in expectations, no surprise tightening, no emergency easing, just stability. This is important because markets react more to changes in expectations than to the news itself. If everyone already expects something, the actual announcement loses its power. That is exactly what we are seeing now. Another headline floating around is the US president addressing the nation. Could that move markets? Maybe. But recently, we have seen that most political speeches do very little for crypto unless they include something very specific and unexpected. Big, dramatic language does not always equal market impact. This is why traders who react emotionally to every headline often lose. Markets care about liquidity, leverage, and positioning, not feelings. Right now, liquidity is still tight. Year-end is approaching, audits are happening, books are being closed, and many institutions are reducing risk temporarily. This is normal. It happens almost every year. Lower liquidity means price moves more aggressively in both directions. That is also why we see sudden spikes up, followed by quick drops. These are not trend changes. These are liquidity-driven moves. The fear and greed index being in extreme fear tells us something else. When fear is this high, most people are already positioned defensively. They have sold, reduced exposure, or are sitting in cash. That means there are fewer sellers left. It does not guarantee a rally, but it improves the risk to reward for patient positioning. However, this is also the phase where people make the biggest mistakes. They see a small bounce, get excited, increase leverage, and then get punished when the market pulls back again. This cycle repeats over and over. That is why I keep stressing this point. This is not the environment for aggressive leverage. This is the environment for discipline. Now let's briefly touch on something important: regulation. I explained before, we recently saw that the new CFTC chair is openly pro-crypto. This matters more than many people realize. After the court rulings, assets like XRP that are considered commodities for retail fall under CFTC oversight, not the SEC. A pro-crypto CFTC leadership reduces long-term regulatory risk. On top of that, there is real progress happening on crypto market structure legislation in the United States. Lawmakers have confirmed that clarity is coming, potentially as early as January. If passed, this could significantly reduce manipulation and increase institutional participation. This kind of news does not always pump price immediately, but it changes the foundation of the market. Institutions do not chase green candles. They wait for rules, clarity, and structure. That is why I always say price can stay boring longer than you expect, but once clarity arrives, moves can happen faster than people are ready for. We also saw continued development from Ripple, including new institutional partnerships, more infrastructure, more execution services, more access for hedge funds and asset managers. These things do not matter tomorrow. They matter over months and years. So when you combine macro stability, regulatory progress, institutional infrastructure, and extreme fear in the market, you get a very interesting setup. Not a guaranteed rally, but a setup worth watching closely. According to Raoul Pal, what happened on October 10th was not classic market manipulation. It was a liquidity shock caused by structural failure. On that day, Binance, the world's largest exchange, experienced an API outage. This meant that market makers could not operate properly. When market makers disappear, liquidity disappears with them. Without liquidity, even small orders can cause massive price moves. As liquidations started cascading, market makers were unable to step in and stabilize prices. Normally, they absorb sell pressure and keep spreads tight, but this time, they couldn't. The result was violent wicks across many assets, especially altcoins and smaller caps. Some exchanges that had their own internal market-making systems were able to absorb part of the shock. Others were not. This created price distortions across exchanges, which made the situation look chaotic and unfair. Someone had to step in and backstop liquidity, and when that happens, it is not free. Whoever provided that liquidity took on enormous risk. Some participants took heavy losses, others made significant profits. That is how markets work during crisis moments. Raoul Pal compares this event to the 2010 equity flash crash. Systems broke, liquidity vanished, and afterward, desks spent months unwinding risk they were forced to take on during the chaos. This is where the current market behavior starts to make sense. If large players stepped in on October 10th to stabilize prices, they now need to de-risk. They cannot dump everything at once without crashing the market again, so they unwind slowly over time through programmatic selling and controlled liquidation. This creates the exact price action we are seeing now: slow grinding down, weak bounces, frustration, confusion, and constant questions about why price is not responding to good news. From this perspective, it is not manipulation in the emotional sense. It is risk management after a crisis. Add to this the fact that year-end is approaching. Liquidity is thinner. Audits are happening. Capital requirements matter more. All of this amplifies every move. This is why Raoul Pal says, this too shall pass. Markets eventually normalize after liquidity events. Inventory gets unwound, risk gets reduced, and once that process is complete, price action can return to something more organic. Now, does this mean price must go up immediately after? No. But it does mean that what we are seeing is temporary pressure, not permanent damage. This is also why blaming everything on manipulation can be dangerous. If you believe the market is permanently rigged against you, you stop thinking clearly. You stop managing risk. You stop learning. The smarter question to ask is, what has actually changed fundamentally? Has Ripple failed? No. Has XRP lost its use case? No. Has regulation become worse? No. In many ways, it has improved. So if fundamentals are stable or improving, but price is weak, the explanation is usually liquidity and positioning, not a broken thesis. That does not mean you blindly hold forever. It means you understand the environment you are in. Short-term price action has been disappointing, no doubt. Outside of brief rallies in November and mid-year, XRP has mostly chopped sideways or drifted lower. That is frustrating. But frustration is part of long-term investing. We are very close to the end of the year. This period is always strange for markets. Liquidity is low, emotions are high, and price movements can feel exaggerated. In traditional markets, this is the time when funds do tax loss harvesting, portfolios get cleaned up, and risk is reduced temporarily. Crypto is not immune to this behavior, even though it trades 24/7. This is why we sometimes see selling pressure toward the last 2 weeks of the year. People close losing positions, rebalance, or simply step aside. That does not mean the long-term trend is broken, it just means timing matters. Many people are asking about a Santa rally. Could it happen? Yes, it could. But it is not guaranteed. A Santa rally usually needs two things: improving liquidity and improving sentiment. Right now, sentiment is still weak. Fear is still high. That tells us that if a rally comes, it may start slow and quietly, not with excitement. And that is usually how real moves begin. Right now, after the Bank of Japan decision, the market is holding up reasonably well. We are not seeing massive sell-offs. Bitcoin is stable. XRP is trying to recover from key support. This is not bullish euphoria, but it is also not collapse. That is a healthy sign. What would worry me is extreme excitement combined with high leverage. We do not have that. What we have is caution, frustration, and disbelief. Historically, that is not a terrible environment for long-term positioning, as long as you manage risk properly. This is why mindset matters more than predictions. Nobody knows exactly what the market will do tomorrow, next week, or next month. Anyone who tells you otherwise is selling confidence, not truth. What you can control is position size, leverage, time horizon, and emotional discipline. If you are over-leveraged right now, the market will eventually punish you. If you are patient, diversified, and realistic, the market gives you time. When I look at XRP specifically, nothing fundamental has broken. Ripple continues to build. Institutional access continues to expand. Regulatory clarity is improving. Short-term price action has been disappointing, yes. But markets often move last when everyone has already given up. The same applies to Bitcoin and the broader crypto space. Volatility is part of the game. Sudden 5 to 6% moves up and down are normal in this phase. That does not mean you need to react to every candle. Sometimes the smartest move is to do less, not more. As we move into the new year, liquidity will slowly return. Big decisions will be made, regulation will become clearer, and capital will reposition. Whether that results in immediate upside or more consolidation, we will deal with it logically, not emotionally. And that is what We Are Cosmic is about. No fake hype, no fear-mongering, no false promises, just calm, clear thinking in a noisy market. If you found value in this breakdown, make sure you are subscribed so you don't miss future updates. Drop a comment, even a simple one. It helps more than you know. Smash that like button if you want to support the channel. All links, including the Telegram group and partner platforms, are in the description below. Thank you for your time. Thank you for your trust. And I'll see you in the next one. Stay sharp. Stay patient. We are Cosmic.